And the Fed has been saying all along that rates are modestly restrictive. All right, well, what's the evidence that rates are modestly restrictive? If rates were modestly restrictive, then financial conditions would not be easing. The economy would not be accelerating. The labor market would not be picking up. And most important, inflation wouldn't be above target for going on half a decade now. And to me, when I look at that question, there's zero evidence that policy rates are restrictive, and I actually think they're accommodative right now.
For a while now, low inflation, stable growth, and central bank predictability have enabled beta, liquidity, and company fundamentals to dominate returns. Today, the picture looks very different. Inflation is higher and more volatile. Fiscal policy is more active. Geopolitical shocks are more frequent, and central banks are no longer the stable anchors they once were. For investors, that spells opportunity. Put simply, macro investing is back. Macro themes are shaping returns across asset classes. And the challenge is not just getting a single GDP or inflation forecast right. It is understanding the distribution of potential outcomes and where markets may be mispricing the risks. I'm joined today by the best possible person to talk through all of this, Mike Medeiros, partner and senior macro strategist at Wellington. Mike works closely with portfolio managers across our hedge fund platform, and he is one of Wellington's leading voices on U.S. economic cycles and policy. Mike brings a particular set of skills to this environment. He helps the firm think through policy, the cycle, and the distribution of outcomes, and he is a critical component of Wellington's macro investing edge. There's no shortage of things to discuss, so let's jump right in. Mike, I'm thrilled to welcome you to InvestorExchange.
Great to be here, Chris. Thanks for having me.
Let's jump right in with the million-dollar question. Are policy rates too tight or too loose?
I find the fact that this is even a debate at this point kind of hysterical, because central bankers and a lot of market participants love to think about this question in academic terms. I'm not saying that's not important. It is. You need to have a theoretical framework for where neutral rates are and why. And a lot of our work suggests neutral rates are higher than previous cycles. But the other thing is, like a market participant practitioner, you have to look for evidence. And the Fed has been saying all along that rates are modestly restrictive. All right, well, what's the evidence that rates are modestly restrictive? If rates were modestly restrictive, then financial conditions would not be easing. The economy would not be accelerating. The labor market would not be picking up. And most important, inflation wouldn't be above target for going on half a decade now. And to me, when I look at that question, there's zero evidence that policy rates are restrictive, and I actually think they're accommodative right now.
So where do we go from here? What tools do policymakers and governments have to get inflation, which is the big problem, sustainably lower, and what are the trade-offs, both good and bad?
Yeah, so we came into the year, and I was fairly constructive on the cycle for 4 reasons. One is a starting point to your previous question, that rates were actually accommodative, not restrictive. The second was fiscal policy is easing, right? That's a big difference from last year. The one big beautiful bill is worth about 1% of GDP, half towards households, half towards corporates. Third, again, clear difference from last year, trade policy and overall policy uncertainty is a lot lower. The effective tariff rate has come down due to Trump administration decisions and Supreme Court decisions. And then last is the deregulatory agenda is kicking in. The credit impulse in the U.S. is the highest since 22, which is partly due to regulation, but partly due to private sector confidence as well. So I put those pieces together, and that to me is consistent with, number one, above trend growth. Number two, a positive inflection in the labor market with the potential for the unemployment rate to actually turn lower over the next 6 months, not higher. We can get into that. And it's not a policy backdrop that's consistent with disinflation. And so what can policymakers do to get inflation sustainably down to 2%? How about they tighten things, right? Like, we've spent the last 9 months with the Fed cutting and easing fiscal policy with core inflation at 3%. That's insane. And so I think if they're actually serious about getting inflation down towards 2%, I'm sure we'll get into this, but the Fed needs to move away from an accommodative stance towards a more restrictive stance, and fiscal policy needs to tighten. Now, for fiscal policy, there is some tightening baked in for 27, but it's extremely modest compared to the easing we've seen. And so I'd put a pretty low probability on that happening, absent a bond market reaction. And then for the Fed, I think there's a growing probability. There's about a hike priced now over the next 9 months or so. I think there's a very reasonable chance that Kevin Warsh's first move as Fed chair is a hike, not a cut.
Talk a little bit about the cycle in terms of what you're seeing right now. So you mentioned there's a plausible case that actually unemployment starts to go lower again. What is causing the U.S. economy to be so resilient in this environment?
On the labor market, I think there were some misconceptions about why the labor market slowed last year. In the second half of last year, when payroll growth slowed, there were a lot of narratives in the market that it was due to AI. And to me, it had nothing to do with AI. If you go back to the first half of 25, the economy grew below trend. And that was a function of some pretty big shifts in trade balances ahead of tariffs, number one. Number two, the largest effective tariff increase in 100 years. And number three, lingering uncertainty, because we didn't know whether we were going to come in and tariffs were going to be up 50%, down 50%, up 10, down 10, et cetera. And so that's a horrific backdrop from an uncertainty perspective. The economy slowed below trend and the labor market responded to that with a lag. Things started to shift, I think, in the middle of the year. Once the One Big Beautiful Bill was passed, once trade policy uncertainty started to come down, then the cycle started to reflect more fundamental forces. And so from here, the economy, absent the government shutdown in Q4, the economy has been growing above trend now for 9 months, and we're starting to see a positive inflection in the labor market. I think all of those four forces I mentioned before are driving things. And so to me, when you have pretty significant labor supply constraints, hiring is picking up and uncertainty is going down, that's an environment where the unemployment rate should be falling, not rising. And so I wouldn't be surprised if going into Q3 or coming into September, we're in a scenario where inflation's above 4% and the unemployment rate is at or below 4% as well.
So I got to jump on the AI question because you brought it up.
Totally.
There's a lot of talk and perhaps hope out there that artificial intelligence or AI is going to deliver a productivity boom that's going to solve all of these supply side constraint problems. Are you a buyer of this notion that AI is the kind of macro escape valve?
It could. I think it's going to take time, though. I find a lot of the discussion around AI fairly binary and singularly focused, where it's like AI is good for productivity, it's bad for productivity. AI is good for jobs, it's bad for jobs. I think you need to put it in the context of the broader supply side. And to me, there's three main, pretty important structural and cyclical forces in the supply side of the economy. The first is deglobalization. That essentially means, from a growth and inflation perspective, that there are less tradable goods globally, and therefore goods prices become much more sensitive to demand. And so that's a very big supply shock for the global economy that's ongoing. Number two is in terms of the labor force. We know the demographic trends in the US and in the rest of the developed world are not nearly what they were 10, 20, 30 years ago. Dependency ratios are rising, working age population is slowing, and that's been magnified in the US through immigration restrictions and deportations. And so that's a very different shift than previous cycles, where now the break-even rate for employment to keep the unemployment rate steady is probably just like 10 or 20,000 jobs. That's a pretty big shift. Again, another negative supply shock. Third, you have the potential for productivity to lift in a more meaningful way due to AI. The technology is certainly groundbreaking and is accelerating fast, but the initial stages are actually probably a bit more inflationary because of all the upfront CapEx investment, the energy usage, the commodity usage. You're seeing that come through in terms of producer prices, et cetera. You have to look at AI in the context of what the broader supply side is doing. And for me, I don't see enough evidence yet on the near-term horizon over the next 6 months or so that the productivity we could see is enough to offset the supply damage from those other two forces. I think we could see most of the AI impacts probably coming out of the next recession, where companies go through the normal firing process and don't replace those lost workers to the extent they have in previous cycles. But that could be a few years away. And so that's partly why there's a lot of hopes that productivity would lead to disinflation this year, and the exact opposite's happening. And it's not just Iran, right? Service inflation is picking up. That has nothing to do with Iran. That reflects domestic underlying capacity conditions in the U.S. It's heading, I think, towards 4% core services. And now you have this exogenous shock from oil prices. And so to me, that's still a recipe that the structural inflation forces are dominating over cyclical disinflationary forces.
So I got to touch upon the Iran question. How does the shock and the potential kind of impact, as you mentioned, through higher energy prices potentially change the outlook on the U.S. cycle?
I think for now, like if you'd asked me 3 months ago, I probably would have told you I think nominal growth's 5 to 6%. Now I'd say it's probably 6 to 7. And so I think it's actually from a nominal perspective a boost, not just from an inflation point of view, right? Inflation's clearly picked up. It's going to pick up more over the next few months. But the U.S. is in a very different place now compared to previous cycles with respect to energy. The U.S. is a net energy exporter, and so it's a terms of trade beneficiary from higher oil prices. Right now, there's a lot of stimulus from the One Big Beautiful Bill, which is more than offsetting the hit from higher gasoline prices. But we're past the point of peak fiscal easing, and so we should start to see more of that negative reflex in Q3. At the same time, from a production perspective, higher oil prices boost domestic production of oil. So in aggregate, it's actually a net positive for the economy. And so I don't know, right, what level of gasoline or oil prices tip things towards more of a consumer hit rather than a boost to aggregate demand. I don't have the answer to that. I think it's somewhere north of $125 per barrel. I think like the theme for right now is more of a nominal boom, and that's consistent with higher bond yields and okay equity prices too.
So you stay close to a lot of what's happening down in Washington, across the aisle. How are you making sense of this policy agenda under the current administration? And do you see any meaningful risks to the midterms this year?
Yeah, I mean, it's not going to help for the Republicans in the midterms. I mean, at this point, if gasoline prices stay here, they probably get rinsed.
Senate as well, potentially?
Yeah, I think the Senate's definitely in play. The Senate's in play for North Carolina, for Texas, Ohio, Maine. Like the Democrats are very competitive, which is a stark contrast between where we were in November of 2024. If you look at Trump's approval is about 36%. That's historically low by any metric. He's 40 points underwater on inflation and affordability. He's about 30 to 40 points underwater on the economy. Even on immigration now, he's net negative. And if you look at the generic ballot test, which is a good kind of proxy for where things stand nationally, it's about Democrats plus 7.5 to 8. So that to me is consistent with a shift to divided government. Things can change. Obviously, we're still a ways away from the midterms, but I think the Democrats are in as good of a position as they could be to capitalize in November. Now, we do pay attention from a market perspective to the midterms, particularly from a bond market perspective. If you go back to 1994, 2018, and 2022, those are all years that's much higher bond yields throughout the course of the year. All of those cyclical bond bear markets ended right around about a week of the midterm elections. All of those midterms represented shifts from full control of one party to divided government. Bond markets tend to love divided government because it reduces the probability of pro-cyclical fiscal policy. And so I think it's too soon to focus on that from a market perspective now. Clearly, the other forces we talked about, I think, will dominate at least over the next few months. But come September, this will be a big area of focus for us and will impact portfolio positioning.
So, Mike, a lot to watch over the coming weeks and months. I have complete confidence in you and the team to stay on top of things and get the repositioning right. So I'm going to switch gears again. You've been at Wellington for a long time now, and you've contributed to the growth and success of both our macro and broader hedge fund business. From your perspective, what makes doing macro at Wellington so unique and advantageous?
So the big one is really macro-micro intersection. I have the pleasure of working with a lot of global industry analysts that are looking at individual sectors and individual companies. My framework and philosophy and process from a macro perspective is very top-down, and theirs is very bottom-up. They're looking at the world from a different place, and when we get that macro-micro intersection, the themes tend to be more powerful, and it increases the probability we can get trends in markets. We spend a lot of the day-to-day looking for intersections between what I'm seeing from a macro perspective and what the global industry analysts are seeing, from banks to banking analysts, to commodities, to consumer analysts, really across the board.
So it sounds like collaboration is really important here.
Yeah, it's critical, and I think it really shines in Wellington.
So Mike, can you give me an example here of how you've been able to use collaboration in this macro sense?
If we go back to 2023, to begin the year, we had pretty high conviction that rates were too low and the market was underestimating the extent to which central banks would continue to tighten. And so at the time, we were positioned pretty short duration in January and February. We knew there were financial stability risks on the horizon. The yield curve was certainly signaling that at the time. But with any financial stability risk, it's always very hard to time when it's going to hit and the potential impact. And so I was actually at Reagan Airport in DC, and Alan Gu, global industry analyst for financials in the US, actually called me, and this was on a Wednesday night, and started to explain what was happening with Silicon Valley Bank, because it was new and it was fresh. And we had a meeting the next morning. We talked about the implications. Because of the importance we put on a distribution of outcomes, this was a scenario that, even though we weren't positioned for, we were aware of and thinking about. And we were able to completely shift positions over the course of a few days to be long duration to capture the downside growth risks that hit after, a number of banking failures over that weekend. And so he was instrumental in helping us get from A to B so quickly. And I don't think we would have been able to do that without him. Another example is in 2025, post-Liberation Day. We were debating the magnitude of a walk back from President Trump, particularly as it related to the tariffs on China. Because at the time, tariffs on China were about 150%. That's not a restrictive trade policy, that's an embargo. And so it was not, I wouldn't say it was clear, but it suggested there was a rising probability that something would need to shift ahead of like back to school shopping and Christmas shopping, et cetera, because a lot of that inventory comes in well before. And so Tina Sun, who's a consumer analyst, was like instrumental in elevating how things just simply were not going to work unless there was a significant walkback of tariffs. We were in close touch every day, and we were able to capture both the large increase in tariffs and the walkback. Those are two big examples, but a lot of this happens on a daily basis, and we're all after the truth. We're all trying to come at it from our own different perspectives, and it's definitely something that makes Wellington unique, is the ability to have that ongoing communication and collaboration.
So Mike, before we wrap up, let's do a quick lightning round of questions. Biggest risk to the bond market, sticky inflation or fiscal deficits?
Can I say both? I think stickier inflation in the near term, but over the medium term, my concerns around fiscal policy, remain pretty acute.
So Mike, I know we already covered this to some degree, but assuming Kevin Warsh is confirmed, is he really going to hike rates out of the gate?
So first meeting, I think he'll hold. That's not a unique view. That's completely priced in. First move in rates, I think will be higher, not lower.
Even with the administration and their wishes?
Even with that, I think Kevin Warsh takes the independence of the Fed seriously. And the last thing you would want to do with inflation potentially double the target and full employment is to cut rates. And so if you're trying to protect the long bond, like cutting rates into nominal growth of 6%, I couldn't think of a worse scenario for long end yields. And so actually tighter policy initially could actually be better for term structure of yields.
Last one, complete the sentence. Macro really matters today because?
I like my job and I want to keep it.
Mike, this has been a fascinating conversation. Thanks for joining today.
Thanks so much for having me. Hope to do it again soon.
The Investor Exchange podcast is a production of Wellington Management. Our producers are Colin Hopkins, Amanda Doherty, Mark Murphy, and Dana Wickstead. The show is recorded, mixed, and edited by Mark Murphy. Production support from Dave Crow and Rasa Sermont. Animation support from Rasa Sermont. You can listen to the Investor Exchange at wellington.com and most podcast providers. Thanks for listening.